Hey guys, it's Jordan with Cashflow AI, and today we're going to talk about covered calls. And so, what actually is a covered call? Well, if you think about an option itself, an option is simply the right to buy 100 shares of a stock at a certain price by a certain date. And so, a covered call is that if you already own 100 shares of that stock, you can essentially sell or short that option and you would get paid for it. So basically, you're selling someone else the right to buy those shares from you at a specific price point by a specific date. And you get paid a premium for that, right? So let's say you own 100 shares of Apple. You can then sell a call and you may get $200, $100 for doing that. And then you basically collect that premium as long as price stays below that example. And it's called covered because you already own 100 shares. So if the buyer decides to exercise the call, you simply deliver on your shares. So let's again take another real example. Let's say you have Apple. Let's say you own 100 shares of that Apple stock at $180 per share. So it costs you $18,000 to get into the stock. Well, you own $18,000, you own 100 shares of Apple stock, and what you can do is you can sell the covered call at the 185 strike price point, right? So you want to sell a call that is higher than the current price point, an out of the money call. And let's say that costs you $200, right? Or the option typically costs you $200. But because you're selling it, or you're, in quote, shorting that option, you collect that $200, right? And again, as long as price stays below 185 within those next 30 days, you're going to make that $200. That option is going to go to worthless, and because you shorted it, you want it to go down, and that's how you're going to make your money. So no matter what happens, as long as price stays below 185 the next 30 days, you're going to collect $200 in complete passive income. Now, let's look at the different outcomes that can happen, right? So again, as I said before, as long as the stock stays below 185, you're going to keep that $200. The call is going to expire worthless, and you're going to profit. Now, let's say price goes exactly to 185. Well, you're still going to keep those shares, and you're also going to get that $200 because if it's right below 185, that option is still going to be worthless, and you're going to make a lot more money because, again, you already held shares at 180. Now price is at 185, so you're going to make an extra $5 per share, plus you're going to keep that $200 if it expires out of the money. Now, let's say price goes above 185, okay? Well, let's say the stock goes to 190, and it just rips higher. Well, you're going to lose money on that option that you sold, right? However, but you were holding 100 shares originally at 180. So you're still going to keep that $200 because you sold at 185. Your profit is still capped, and you are going to make less money than if you just originally held the shares. However, you're still going to have the opportunity to lose money. So in 2 out of 3 scenarios, you still keep that premium. In scenario 3, you still profit, but you miss some extra gains if you weren't holding or doing a covered call, right? So again, let's say price is at 180, gets to 185, right? Anywhere below that 180 or 185, you're still going to make that $200 gain. And then anything above 185 is basically you're capping your max gains on it in hopes of protection for your downside. So let's take a look at the math scenario, right? Again, so let's say stock is at 183. Well, the stock from shares went up to 183. You bought them at 180. So you made $300 on the actual shares. And because the premium you got sold was $200, you made $500 in profit. Now, again, let's say it goes to 185. Well, now you made $500 on the shares. You still made $200 on the premium because that expired worthless. So you made $700. Now, again, scenario C, stock goes to 195, right? So because it goes to 195 and you sold the option at 185, you're going to sell your 100 shares that you bought at 180 at 185. So you're going to make the $500. And you're still going to collect the premium, $200. So you're going to make $700. Now, again, if you just held those shares originally, you would have made about $1,000. So you missed out on some extra money by getting the covered call. However, you do protect your downside in doing so. Now, why should you even use covered calls? Well, because if the stock is flat or slowly rising, in your case, selling at the strike price, you can generate income from those holdings, right? And even if the stock is in a range-bound market, if you're selling out of the money calls, as long as you like that stock, you can basically make money simply by holding that stock, making weekly or monthly income by selling those covered calls. Now, if stock is in a strong uptrend, you're going to cap your gains. The one downside is if price keeps going higher really, really fast, you're actually going to cap your gains and not take advantage of actually just holding the shares instead. And typically before earnings, you don't want to do it. And again, you don't really want to do these if it's not a stock that you like to hold long term, because you need 100 shares of the stock. You need to own 100 shares for this to work. So if you don't want to do that, it's not really going to make sense. So it's really best for a long-term portfolio if you SPY, Apple, QQQ, whatever stocks you like, if you just sell calls on them, it doesn't really cost you anything because you already own the shares, and it's a very easy way to make extra income. So how do you actually know what strike price to choose? Well, again, let's say the current price is 180, okay? Typically what's recommended is most people select out of the money options. So again, if you're getting covered calls, the stock price is at 180, you want to sell calls that are above the strike price, right? So do you want to do it at 185, 190, 200, 300, or do you do it 181, 182, right? What do you know to do? Well, typically you want to do it at a range where you don't think price can get to in that time, right? So let's say price is at 180, and we believe that in the next week, price, it could go up to 183, 184 realistically, but getting up to 185 is very unrealistic. And so what you can do is you can sell that 185 call because you don't want the option to go in the money. You don't want price to go above the call that you're selling. You kind of want to play that middle game and kind of have it in the middle. So typically what I believe is wherever you want to sell it, make sure that price doesn't go in the money. Again, it's not the end of the world if it does, but you're going to be capping out your gains if you do so. So 5 to 10% above. If you typically do it, at a delta range, like a 10 delta, 20 delta is typically good because you typically have a 10 to 20% chance of that option going in the money. Now, a lot of disadvantages as well, right? Obviously, all the pros we can talk about. You get extra income. It works in really flat markets. You can do this every single week, every single month with options. But a lot of disadvantages, right? If the stock just rips higher, maybe there's really good news or earnings come up or something like that, you're basically capping out your gains. So what that means is, if you sell the option at 185 and you own shares at 180, well, if the stock rips to 200, you still own that exercise. You still own that option that you have to sell at 185. So even though it's at $200, you technically sold your stock at 185, so it caps your upside. And also, if the stock still drops, you are going to make that premium, so you're going to get extra income for doing so. But again, you still own 100 shares of stock, which can be a lot of money for some people. So if the market just dumps, you still have to own those 100 shares, and that can be much of a bigger loss compared to the premium that you're getting from the actual covered call. Okay, and so to get your first covered call, right, process is really simple. First, you have to find a stock that you like, one that you want to hold long term, right? One that you can afford to own 100 shares of and understand the risk on, okay? Then you want to choose a strike price above it. So if you're trading SPY or let's say Apple to $200, you can get the 205 or the 210 or the 220 call option. Get it 30 days out, 1 week out, select a date, whatever you're comfortable with. A lot of people like to do these every single week because options expire every single week on stocks. Or you can get it 30, 45 days out, get a little bit higher. You sell the option, okay, so you're going to just sell that call, and then boom, you get the premium. And then as long as price stays below and you wait time pass, as long as it stays below that covered call, it's going to expire worthless. You do not need to touch it. You don't need to do anything. It's just going to go into your brokerage account and you're just going to make that money. Okay. Now, a lot of beginner mistakes. All right. Selling calls on stocks you don't want to lose. Never do that. Like I said, always only sell calls and buy these shares on stocks that you like in a bull market. Don't get strikes too close. Okay. You're going to make more money if the premium is closer, but the odds are is that if price goes up, well, you're actually going to cap your gains on that, and you would have been better off just holding the shares anyways. Always keep an eye out for earnings. Make sure you're keeping an eye out because you never want to really do this during earnings because it's just a crazy move. You don't want to do that. And then selling too far out, right? You don't want to get like longer than 45 days, 50 days out. It's just harder to collect that income. And I mean, it's not bad. You can still do it, but typically weeklies, bi-weekly, or 30 to 45 days is typically good. So key takeaways just for you to review. Again, covered calls when you can sell someone the right to buy your shares, 100 shares of your stock at a specific price. You get paid a premium for that. It's the best way for you to generate monthly income or weekly income on slow or moving markets. The only risk is that on your upside, if the stock goes really higher, you're not going to take advantage of that opportunity. And it's really best for people who have a lot of cash. They have 100 shares of stock that they really like, and they want to be able to sell calls against that and make some extra income. So hope you guys did enjoy this video. Please go ahead and subscribe down below. I'm putting out new videos every single week on this channel, and I'll see you all on the next video.